Welcome back to the ICT or SMC Beginners course. Today we're covering ICT macros and times of day. Now, if you're not familiar with why time is important, let me give you a quick underlying lesson here. Going to take about 20 seconds. So essentially, when it comes to candlesticks, we know that we're all based off of time. Every single aspect or piece of data is based off of time. Everybody talks about the y-axis here on the chart, which is price. But more important potentially than price is actually time. So if you're one to keep getting stopped out right before the move actually occurs, you're probably not implementing time into your trading. And today, I'm going to go over all these key points in time, these 20-minute intervals, and very specific macros in time that will help you time the market correctly so you're not getting stopped out before price moves in your direction and you're actually getting involved in these low resistance liquidity runs. As ICT traders, we understand that price is controlled by an algorithm and not this classic buying and selling pressure. Now, what this algorithm requires to run is two key components. Like I mentioned earlier, we have price, and now we're introducing the aspect of time. Time is going to allow the algorithm to determine, like it sounds, what time of day, what time of week, what time of month, and what time of year we're actually going to be able to anticipate these runs on liquidity. Now, in this video, I'm going to be covering two main topics today, and that's going to be the ICT macros and key times of interest like midnight open and 1:30 open. Now, to start us off here, let's go over these ICT macros. These ICT macros are going to be very specific times of day where you can expect one of two things to occur. You can expect liquidity to be ran or imbalances / fair value gaps to be rebalanced. Now, when actually are these macros? Well, the ones that I want to talk about first here are going to be at 9:50 to 10:10 a.m., 10:50 to 11:10 a.m., 11:50 a.m. to 12:10 p.m., and 3:15 p.m. to 3:45 p.m. Now, these are all going to be index specific. So if you're trading Forex, they're going to be slightly different, and I would say more so focus on kill zones, which I'm not going to cover in this video exactly. But when it comes to specifically index futures, so it doesn't need to be futures, but indexes, so the NASDAQ, the S&P 500, the Dow Jones index, and anything else that might be like that, these are the key times of day that you want to look out for these things. Now, there are more macros, but these are the ones that I want you to focus on right now. And we're going to go ahead and hop into price action so I can actually explain these with the live examples. Okay, so taking a look at the chart here, what I want to mention first is we do have this white line here that's going to denote our 9:30 opening price or our New York equities open. If you take a look at this red line here, that's actually going to be at 9:50, which is the beginning of our macro. And I'll just remind you, this first macro goes from 9:50 till 10:10 a.m. and its main two jobs are going to be A, to run liquidity, or B, to rebalance an inefficiency. So just taking a look at this 1-minute chart here, it's obvious that we've got some sell-side liquidity down here, and we're actually in a bit of a market maker sell model. For those of you that know how I like to trade in my trend setter model, this is actually the breaker block right here, and this is what we would have been taking our shorts off of. But for those of you that are unfamiliar with that, essentially what I want to talk about here is that we have untapped liquidity here that we're expecting price to run towards. And when do we expect it to get taken out? In between this period of time, between 9:50 and 10:10. Now, not only do we have this liquidity, but let's go ahead and hop up to a little bit of a larger time frame here. You can see we have this really nice liquidity pool here. It's going to be on the 5-minute as well as on the 15-minute. And then we also have, if we go back to the 5-minute, we have this liquidity pool here. And we even have this inefficiency down here, right? So this is a fair value gap that has not been traded to. As you can see, it's been left open. So price does need to rebalance this inefficiency, which means it should come to the low of this fair value gap, right? We're not looking for price to come in and bounce off of this unless we're bullish. And in this case, we're bearish and we're expecting price to rebalance an inefficiency, not just bounce off of it. So let's see what price does in between these two red lines here. Comes out, takes out both of these sell-side liquidity pools, and then ends up taking out this other sell-side liquidity pool and rebalancing that 5-minute inefficiency all inside the macro. So as you can see, this is all occurring in between this 20-minute period between 9:50 and 10:10. Now, does this happen all the time? Is it reliable? It's not going to always be going through 3 pools of sell-side liquidity and rebalancing an inefficiency, but it is going to be very reliable in doing at least one of those two things every single time. So let's go ahead and just fast forward here a little bit to our next macro, which is going to be at 10:50. So let me just mark that out so we don't get too ahead of ourselves here. Remember, this is all on the same day, 10:50 to 11:10. Okay, so this is our next macro in between these two red lines. I'm going to delete this other stuff over here just so we're not confused. And let's just catch up to, fast forward here to our next point of interest, or time of interest, sorry, I should say. And if we take a look at this right here, obviously we have some sell side liquidity here, but we have started to, sweep some buy side liquidity here as well. And once again, if we zoom out, let's go to the 5-minute, for example. Okay, it's giving it away. What I was going to say is we have this clear low right here, where once again you have your breaker block and your market maker sell model down to this low. Now, when is this major sell side liquidity pool going to be taken out? Well, the hint is in this aspect of the chart here, in time, not necessarily price. You're looking for this price to be taken out. You're looking for 17,778 to be taken out in between the time frames of 950 to 1010 or 1050 to 1110 in this example here. Right? So what does price do? It obliterates down, closes below this low, continues to sweep out or run towards sell side liquidity, and ultimately pushes up and does what? So not only are we taking out sell side liquidity here, but we're rebalancing this inefficiency. Price rebalances that inefficiency on this candle right here. And then price rebalances this inefficiency up here. So if you were bullish and you wanted to go long off this low, you'd be looking for these fair value gaps to be traded to and through. And we also come up into this inefficiency right here. And as you can see, as the premium inefficiency, that would be your target if you were long down here, expecting lower prices, but a run from external to internal liquidity. You can see price comes all the way up here to the tick and rebalances this premium fair value gap at 17,850. That is exactly the high of that candle there. Once again, price is still inside the macro. And now we can move on to our next macro, which is the first macro. For what it's worth, the 950 to 1010 macro is my favorite. This one is obviously next. And then going into our third macro of the AM session, which is actually going to lead us into the lunch hour, is going to be from 1150 to 1210. So let me just go ahead and mark that out so we don't get too ahead of ourselves. 1150 and 1210. And we can go ahead and get rid of all this stuff on the chart over here now that we were using. Okay, so what would you actually expect to occur between this 1150 and 1210 time? Is it any different than typical? Well, the answer is realistically no. You're going to want price to either run liquidity or rebalance an inefficiency. Now, we are currently trending to the downside here, so we don't necessarily want to fade that unless we've had a really large trend day. So not just this session here, I should say this is the New York session. So if we're taking a look from, once again, this white dotted line here, appear in a second here, this white dotted line is our 930 opening price, and this is our New York session. We've clearly been trending for the New York session, but overnight we have not been trending, right? We saw Asia, then London went down, came up, took out Asian sell or Asian buy side liquidity and London buy side liquidity in this pre-market session, and then started our descent back down towards our drawn liquidity, which would be lower here on like the hourly time frame. You can really get a nice pool of liquidity down here. So we would be looking for price to ultimately be running towards this pool of sell side liquidity here. And that's just a market maker model thesis or theory there. But essentially, once again, we're expecting price to continue to trend lower here. So where's our sell side liquidity? Well, like I mentioned, it's actually going to be this low here. I do not expect price to run 0.73% in 20 minutes. So I'm not expecting that low to be taken out, but obviously we do have some sell side liquidity here. Potentially we come up, rebalance like this 1 minute fair value gap. Maybe it's just a rejection. If we're bullish, you would be expecting price to rebalance this. If we're bearish, you would be expecting price to reject this. Okay, lots of you don't quite understand that. You think every fair value gap should be a rejection point or support point. If we're trending and we're expecting lower prices, that's correct. If we're expecting a bounce or higher prices, these things should be expected to fail. Now, in this case, we're expecting lower prices, so we don't think they're going to fail. Let's just bring us up to this red line here. As you can see, now we're at our 1150. We've now engineered or generated some sell side liquidity here in the form of these relative equal lows. We really want to see those lows taken out there. So let's just go ahead and see what happens in this macro. Price comes up towards that fair value gap again, and then starts to sell off towards these relative equal lows and continues to go lower in this macro. Now, that kind of caps off our beginning of the daytime here. So from the AM session from 9:30 till about the lunch hour at 12 o'clock, these are the specific times of day where you're going to have a higher probability chance of getting good quality setups and having these low resistance liquidity runs. Now, the last macro that I want to talk about today is going to be this 315 to 345 macro. Once again, this is on the exact same day here, so Wednesday, the 17th of April. We do have some macros in this 1:30 time out, or 1:30 time period, I should say. And I'm not going to talk about that today because that's more of a Judas swing theory, and I'm going to do that in a whole different video. But if you want to see all of these macros laid out in a really nice way, with all of the specific times, the time zone that you're going to be looking for these in, and everything like that, I do have a really nice post on my Instagram that you can go ahead and check out. The link should be in the description to my bento box or my link tree, whatever it's called, and you can just go ahead and find my Instagram there. But essentially here in this 315 to 345 macro, once again, we're looking for sell side liquidity to be purged, or we're looking for an imbalance or a fair value gap to be rebalanced. So this line here that you can see we came to and through here is actually that hourly liquidity pool that I was mentioning. Now, price did push up off of that and actually came up to this original consolidation area of this market maker sell model, or buy model, sorry. And as you can see, just for confluence, for everybody that knows how I like to trade, this fourth standard deviation is why we rejected price up here above this original consolidation and these relative equal highs. Anyways, once price got above this high, we could be expecting price, in my opinion at this point, to probably come back down and we'd be looking at lower prices. Now, I would be looking at this low, see if we can get a low resistance liquidity run down to here. I'm going to get rid of this other hourly liquidity pool just so we can have a bit of a cleaner chart here and know what we're looking at. And I would also keep this low here on my chart. Now, doesn't mean it's going to happen. We just know that it has a high probability chance of happening, right? Let's say we had FOMC the next day. Well, we're probably not going to make any large range moves in the PM session before FOMC. So just keep these things in mind. This isn't a end-all be-all. Macros are going to save the way you trade. They're going to significantly help the way you trade and analyze the markets. But if you're on a low probability day where you're seeing manual intervention, a macro is not going to save you. It's going to help you, and it's going to help you time the market and get out of those consolidationary high resistance liquidity areas, but it's not going to save you. You have to use logic and overarching narrative to determine whether or not this is a high probability setup on its own. Anyways, since we're more bearish right now, we're not really expecting anything to occur to the upside, but we do have this 5-minute fair value gap here that's pretty obvious. So if price wants to rebalance this inefficiency, that's totally okay. And we could be able to potentially even rebalance the inefficiency and go lower, or vice versa. But essentially, that's our 5-minute fair value gap. It doesn't always have to be a 5-minute. Don't get tied up on the time frame. 15-minute is totally fine as well. But essentially, you're looking for price to rebalance this inefficiency or run the liquidity pool. And as you can see, once we come up to this 315 time, we actually do come up and we rebalance that 5-minute inefficiency there. And we actually don't end up getting down towards that sell side liquidity. We end up finishing our macro right here. And then there's this 350 time, which is the MOC imbalance. That's where you start to get some big move. And once again at 355. For those of you that don't know, just keep those times in mind. You're going to get really large candles historically at those two specific times of day. Anyways, price does come up, rebalance that 5-minute inefficiency that we were talking about right here, but it does not run towards this sell side. So it runs out this sell side liquidity pool here, but that's about all it does in this macro. Now, this is maybe a good teaching lesson or a good example so I can show you it's not always an end-all be-all. Get in the trade, hold it until the end of the macro. It's not always going to work perfectly like this. But these are points in time, points throughout the day where your setups are going to be higher probability and you're going to have a higher likelihood of making a profitable trade and finding these low resistance liquidity runs. Now, I hope you guys found that insightful. If you do have any questions, make sure to let me know in the comment section down below, and I'll do my absolute best to answer those. If you enjoyed the video, make sure to hit the thumbs up button, subscribe if you're new, and I'll catch you guys in the next one.